nice music there now. Thank you for warming up, everyone. And hello, good afternoon, good morning, depending on what part of the US you all are in. But welcome and thank you for joining us for today's another tax independence webinar. And I want to really appreciate and acknowledge the all time that you are investing in this and cheering everyone up. I really appreciate on that. And without further delay, let's get started with the webinar. How do we minimize lifetime taxes and the tax solutions to reduce your tax payments? We are going to go over and cover, just to give you a brief overview, we will cover about Biden's proposed tax plan, as well as what, things that can be done to minimize your taxes at no matter what income level your business could be, whether it's a business making $100,000 in taxes or business making multi-million-dollar in revenue. Either one of the two can benefit. So let's dive in. From overview for many of you who are new and joining us for the first time, KB Tax Advisors CPAs is the industry-leading advisory firm founded by two sisters, myself and Taruna. And we are one-stop shop solution for all tax and accounting needs of our clients and help our clients with the customized, innovative tax strategies to help them live fruitful lives, achieve financial freedom, and to leave lasting legacy for their family. And we serve clientele throughout the USA. We are not an average CPA firm, and our goal is to help our clients create more time, more money, and more magic in their life. And I'm proud to say, we have been top 100 tax professionals award. We won top 100 tax professional award in 2019, as well as in 2020. And we have been awarded best accounting firm with the Reader's Ranking Award in Lehigh Valley last year as well. And this is a social business. We just transitioned from an ordinary accounting practice to a social business. It's our way of contributing an innovative way to change the world by providing better nutrition to the children and providing them hope. So for every dollar you spend with the KB Tax, we will contribute that many servings of fresh and nutritional meals to medically fragile children under the medical care for the whole month. And I'm proud to say that so far, year to date, we have provided 13,230 meals, which is really impressive. Intellectual property notice, the materials in this presentation has been prepared by and is the property of KB Tax Advisors CPAs. All content, including images and impressions, are protected under the U.S. intellectual property and trademark laws. Again, the purpose of this webinar is the education only, if you are seeking for a specific tax advice, please make sure to reach out to a professional tax accountant. I hope you guys can see my screen. I didn't even ask that. Let's see.
Here you go. We see it now.
Perfect. We made it work.
It's working.
Thank you very much, everyone, for your patience. For those of you who don't know me, my name is Minal Babaria, CPA, Certified Tax Coach, Certified Tax Planner, and Certified Concierge Accountant, CEO and founder of KB Tax Advisors CPAs with more than 15 years of tax industry experience. There are millions of accountants in US. However, there are only about 700 accountants who are certified tax coaches like me, and I'm one of them. And as a certified tax coach, I'm extensively trained in identifying loopholes, deductions, and credits that saves my clients thousands and millions of dollars in taxes. And I'm proud to say I'm serving on the Intuit Tax Council member board for 3 years and proud member of Forbes Finance Council. And how I got started with this new way of doing business, as we all know, the business owners are the backbone of any thriving economy. And my father was one such entrepreneur but he had difficult time succeeding without the proper advice and strategies in place. So when I began my career as an accountant, I noticed that the most accountants only offer tax preparation, or we call compliance services. That's when we decided to start our own firm, providing small business owners with strategies that will enable them to reduce their taxes, increase their net worth, and build lasting wealth and a family legacy. And I'm proud to say that we have made it a family mission to help small businesses succeed through tax and financial planning that leads to incredible growth and wealth generation. And my both sisters join me in this journey as well. And we all three sisters are CPAs, so that no other business owner have the same struggles like what my dad and our family had. So I just wanted to get familiar, everyone, with the tax avoidance, tax evasion, tax loophole, and tax fraud, what it really means. Tax avoidance is actually legal, using the tax laws to reduce your taxes, and it's the one of the way that we can avoid taxes. Whereas tax evasion is avoiding the tax law to reduce taxes, which is not legal, it is illegal. And tax loopholes, which is using the tax laws to reduce your taxes legally. Tax fraud, as the name says it all, it is completely illegal to commit the tax fraud as well. So anything that I would talk about is staying within the IRS tax laws and the case studies. And make sure you're ready to take real good notes. And be sure, if you have a question that you want to be answered live at the end of the presentation, make sure to post your question in Q&A section. And if you want to share any other feedback, I would say use the chat option of the Zoom window. So in response to coronavirus, since 2020, or I can say last 15, 18 months, we have seen altogether 6 bills being signed into a law. And the first came in, which was Family First Coronavirus Response Act, where we all got the PPP loan. And then came in the CARES Act, where there was extra PPP loan, and both of this had stimulus bills and stuff like that, unemployment compensation, and a whole bunch of other benefits. Then came in interim emergency bill, which kind of infused more cash to the PPP and whole other, funding options. Then came in coronavirus relief and omnibus agreement, which was the last bill that was signed by Trump. And then comes American Rescue Plan, American Family Plan, and American Jobs Plan, which are new one, which were signed by Joe Biden. Um, if you look at all of these 6 bills in less than 15 months, whole lot of money that has been infused in the economy that has never been done in the history of the US, America. And what it really means, government was already under deficit. Infusing this much of cash in the economy, we have created even more deficit. And somehow someone would have to fill in the gap. And that will be people like you and me if we don't take action right now. As we all know, the tax rates of the US have already been higher. On top of that, raising more taxes would cause people like us to shut down our businesses. And our goal is to help more and more of business owners to keep their hard-earned money so that they can continue maintaining the jobs, the employees that they have, and can have a lifestyle for which they jumped into taking the risk of business ownership. Top marginal income tax rate, as you see here, by each country: France, Germany, UK, United States. And US, it's like the blue one you see, have been highest compared to the other countries besides UK. And seems like we are on the verge of getting even higher, as we see here. And let's go over the reform of the corporate taxation. I'm going to only cover few tax changes which are proposed, which I can see can benefit huge population of our attendees today. If I can summarize in a nutshell, every single tax rate or tax situation that our IRS charges have been impacted or will be impacted with the Biden's proposed tax plan. What I really mean by that, either tax rates have been increased, and if the tax rates have not been increased, then the threshold to be eligible have been changed so that you are getting the lesser tax benefit versus what you used to get in the past. So either the tax credit limits will be changed, or the dollar credit has been reduced, or the tax rate itself has been increased. The raised corporate income tax rate, I'm pretty sure many of you would have heard about it, is switching from 21% to 28%. And this is only applicable for the C Corp and for taxable years beginning after January 1, 2021 and before January 1, 2022, the tax rate will remain at 21%. But moving on from January 1st, 2022, it will be at 28%. This has been proposed, and we will see once it gets passed, that time it will be finalized. 15% minimum tax on book earnings. In the past, not most business owners paid taxes on the book earnings. This is something new and different. So we are talking about imposing a 15% minimum tax on the worldwide book income for corporations with such income in excess of $2 billion. Taxpayers would calculate book tentative minimum tax equal to 15% of your top line revenue we are talking about, not the net profits. We're talking about the top line revenue, which is calculated after subtracting book net operating loss deductions from the prior years from the book income, and less general business credits. If you're getting any R&D, clean energy or housing tax credits or foreign tax credits, those are reduced, and whatever the income remains on that 15% minimum tax on book earnings. Tax incentives for onshore jobs. Of course, the government of the US, they want to keep the jobs as much as possible within the US to reduce the unemployment rate. And hence, they are giving more tax incentives for onshore jobs on general business credit equal to 10% of the eligible expense paid or incurred in connection with onshoring a US trade or business. And this allowed deductions for expenses paid or incurred in connection with offshoring a US trade or business. Again, the proposal would be effective for the expenses paid or incurred after the date of enactment. Just because something hasn't happened in your lifetime doesn't mean it can't happen. And we have seen how quickly tax bills have been signed and made effective into a law. In the past, it took years to convert the bill into a signed law. Biden proposed tax policies are not yet, an active law. It's actually a draft bill unless it is signed and approved as a law. But with the COVID, we witnessed a rush order process on enacting CARES Act and FFCRA, which is Family First Coronavirus Response Act. I wouldn't be surprised if some of this proposed enactments passes as a law. So we have to be ready, as if it were to go retroactive. We have to be ready and prepared proactively. And when we look back at the history of the America, the Omnibus Budget and Reconciliation Act of 1993 was signed into law on August 10, 1993, whereas it was made effective January 1st, 1993, which is retroactive. The Patient Protection and Affordable Cares Act was signed into law March 2010, was made effective January 2013. This is usual that when the bill is signed into law, it takes at least few months or years to be effective. And when we have that enough of time in between, we can plan proactively what is our game plan going to be to reduce the taxes. Whereas this kind of situation, if this were to happen, then it's lots of juggling around and stress. The money you may have already spent, which at the end of the year you will owe to the IRS. So it kind of is very tough to budget for yourself as well. As we see here, again, Tax Cuts and Job Act, CARES Act, Family First Coronavirus Response Act, All of them were signed into law and put effective very quickly. There was not enough time. And for those of you who remembers with the Tax Cuts and Job Act, when there was a massive change with the standard deduction and property taxes on real estate property, so many people kind of tried to prepay their real estate property taxes just to get that extra benefit. Because we had about 8 9 days in between the law was signed and it was made effective, so people were kind of able to do that time. Now, if something like this happens, it's signed into law and made effective retroactively, you don't have much time. The proposed tax rate changes as it relates to side by side current law versus Biden proposed law. Corporate tax rate proposed to be changing from 21% to 28. Capital gains tax rate changing from 20% to 39.6%. Huge bump, almost double. Top individual income tax rate 37% to 39.6%, even though it's like minor 2.6% shift. When your taxable income is that high, even 1% shift makes a huge difference. So that 2.6% bump also makes a huge difference on your taxes. FICA taxes 6.2%, which under the current law stops at $137,000 of salary, which will continue any salary above $400,000. So if you're paying yourself higher salary, this is something to think about. And there are people who pays themselves salary of $400,000, $500,000, even $700,000 a year. I just met one of the doctor last year who was paying himself $1.3 million a salary. And that could cause lots of wasted money in payroll taxes, which you don't have to. Top effective rate on pass-through income, right now it is at 29.6%, which is expected to go to 39.6%. And let's not forget, estate tax rate, which is at 40% right now, and it's about to increase 45%. So what it tells me, like the story of an ideal business owner who is the first one to come in business, last one to go home, first one to pay all the bills and all the employees, and last one to get paid. And when you plan to retire and you want to leave that whatever minimum wealth you have remaining for your next generation, in the past, we were paying 40% tax rate and we will pay 45%, which is even higher. So ideally, IRS is taking money from your future generation's hands. I mean, there's nothing left for you. Where is the business owner incentive here? But don't get nervous about it. There are ways to work around. And again, legal ways to work around. Another thing government is looking for, strengthening the taxation of high income taxpayers and talking about increasing the top marginal income tax rate, which I think we already covered in the comparison before. Reform the taxation of capital income, taxing capital gains of high income individuals at a 37% tax rate. And it only applies to AGI over $1 million taxpayers. And this proposal will be effective for gains required to be recognized after the date of announcement. And we don't have the date of announcement yet, so it will remain at the old capital gain tax rate. But it's not just 37%. To that, you have to add 3.8% of net investment income tax rate, which will make it as 40.8%. And it includes a statement that the long-term capital gains will be taxed at 37%. However, if the top tax rate changes to 39.6%, then it will adjust to the top tax rate. So what it really means, you are in the highest tax bracket, 39.6%, because of the capital gain, bumping up your marginal income tax rate. And then all the income from all the sources, regular income and capital gain, everything will be taxed at 39.6%, not at 37, 39.6%. So for example, a taxpayer with $900,000 in labor income and $200,000 in preferential capital income would have $100,000 of capital income taxed at the current preferential tax rate and $100,000 tax at the ordinary income tax rate. There will be a pass-through business income for high income taxpayers in excess of $400,000, which is subject to either net investment income tax or SECA tax rate, which is Self-Employment Contribution Act. So if you are a partnership or you are an S corp, and at your, because it's a flow through entity, and at your personal level from flow through entity you are getting more than $400,000 of net profits, then you will be eligible for either net investment income tax of 3.8% or self-employment contributions act, which is again 3.8%. So that's extra tax that will be imposed on income over $400,000. So what it tells me, I think we should increase our expenses, deductions, and credits instead of paying excess tax on this $400,000 above of the net profit. Limited partners and LLCs, members who provide services and materially participate in their partnerships and LLCs would be subject to this SECA tax on their distributive shares of partnership or LLC income to the extent that this income exceeds $400,000. Now, this also includes your distributions in the business. In the past, if partners and S corp owners, they did not pay any taxes on the distributions. So this is a huge change. And the self-employment exemptions for an S corp with more than $400,000 of income is removed. What it means, any excess distributions over $400,000 will be taxed per company level. So in the past, whenever you had one business which was like a cash cow and you needed money to invest in another business, I know many of you take a huge distributions to yourself and then invest money in another business, kind of tax free, which now you will not be able to do it. And if you do it, which is fine, you will have to pay taxes on that. So that's kind of a little bit of a setback. Tax carried interest as ordinary income. Tax as ordinary income, a partner's share of income on an investment service partnership interest in an investment partnership as well. So you are a limited partner in a partnership, and you're trying to, you're just a silent partner and you have a passive investment. Again, you will be eligible for the SECA tax as well for any income that exceeds over $400,000. Repeal deferral of gain from the like-kind exchanges. As we all know, Joe Biden doesn't like 1031 exchanges, and hence he's making 1031 exchanges rules a little bit different. So it's not as lucrative for people to do kind of 1031 exchanges and defer the taxes. And in my personal opinion, 1031 exchanges are not the best option for most people. And the reason why I'm saying it, because it only defers your taxes to the future date. It doesn't eliminate your taxes. It only defers it to the future date. And when we say it's deferring your taxes, it means you will pay taxes at a higher rate in future. And if you were to, if your kids or next generation were to get inherited that property, which means you're leaving out your kids to pay for the taxes for the income that you had when you were living and doing business, and that money they may not really have either. So that's the whole reason I'm not in favor of the 1031 like kind exchanges. But Biden's proposal at the moment is saying that it would allow the deferral of gain up to an aggregate amount of $500,000 for each taxpayer, or up to $1 million in the case of married individuals filing a joint return. So if you have up to $500,000 per individual or $1 million of capital gain, you can do 1031 exchange. You are allowed to defer your taxes. Anything more than that, you're not allowed you're disqualified for 1031 exchange. And the proposal would be effective for exchanges completed in taxable years beginning after 31st December 2021. So if you're looking to sell your property, maybe right now is the best time instead of selling it in 2022. And of course, right now the sales price is pretty high as well. So I'm going to cover some of the case studies which are actually our real clients, and we have the written permission from them to share the case study, without which I do not share any case study. So meet my client, Samina Sharp, and how a proactive tax planning eliminated huge tax bill for her and her family. So my client, Samina Sharp, her parents owned 3 hotels, victim of the huge fraud by their hotel manager. And due to aging, Samina took control of managing the business, including accounting and tax area, and had bad experiences with multiple accountants and tax attorneys. And she almost lost her faith in the accountant. Not only she was operating under the wrong entity structure and filed completely wrong sets of tax returns, but also missed filing the 1099 forms, and many expenses were missing on her tax return as well. Growing up, she has always seen her parents paying 100 to $500,000 in taxes, and we helped her evaluate entire business structure, took actions to correct erroneous filing by the prior accountants, which resulted in amending the tax return previously filed by old accountants, and they received a refund of $70,000 plus, first time ever in the history. And we also helped her customize tax planning to eliminate about $1 million in capital gain tax when they decided to sell one of the hotels. So, and here is the email from her. I haven't seen a refund since I was like 20 years old. Fascinating stuff. And when they plan to sell one of the three hotels in 2020 for about $2.5 million, the hotel was actually fully depreciated already. So when you are selling the hotel, you have to recapture all that capital gain. So she was expecting whooping 37.10% tax on 2.5 million sales proceeds, which is almost $927,500. They were concerned as they were not eligible for 1031 exchange because they wanted to use the sales proceeds to build another hotel, which was already in construction. So our team of qualified professionals brainstormed on multiple strategies to handle this hotel sale in a way that would eliminate almost 100% of tax on $2.5 million sales, which resulted in eliminating $927,000 in taxes. And usually, of course, everyone, and I'm pretty sure you also have, when you have this kind of a huge success result, you want to share it with everyone. And I had that intense desire as well. So I didn't put her name, just share it on the social media. And there is a person named KJ saying, he's like, this seems to be a shady post. And Samina, I don't know, somehow she saw the post, even though I did not identify her, she identified herself. I'm actually the client this exact example pertains to, and Minal's team includes an independent tax attorney and my personal estate planning attorney. I will attest to this not being a shady post. The numbers pencil out how it is described above, and I don't believe anyone could get this many independent legal professionals to make something up. So then she went in detail what else we helped her with, but then she's offering her this KJ saying, "I'm happy to discuss how Minal Babaria and her team gave me a big part of my life back. And above all, what is most important, I worked for EY, Ernst& Young. It is Big Four international public accounting firm. She herself had worked for them for 12 years. So the things that we do is so unique and different that even if she worked with EY for 12 years, she did not know any of it. And what we do is not something covered in CPA, EA curriculum at all. And that's the reason most accountants don't even know it. So those are the results that we are really proud of our team. Additional funding for tax administration. This is something coming as well. The new budget that was just signed in May 2021 provides the $72.5 billion in mandatory funding. The proposed allocation adjustments for 2022 would fund $417 million in enforcement and compliance initiatives and investments above current levels of activity. So, we had lots of PPP loan, EIDL loan, and lots of co-mingling and, fraud and unethical activities have happened. And government is aware of that. And that's why they have allocated this huge chunk of money to prepare the team to go back and audit and, do that analysis as well. So what it really means, whether you have done everything correctly or you have by mistake messed up somehow, rather than waiting, just that it will kind of pass through. I would say you need to be proactive and take actions that even if you were to get audited, everything will be nice and clean. Because this proposal would direct the additional resources go toward the enforcement against those with the highest income rather than the Americans with actual income of less than $400,000. And another thing, many business owners think they are very smart. They can cheat IRS and IRS wouldn't even know it. Believe me or not, IRS is even smarter than us. And whether they have the technology or not, there have been so many people who have been cheating against them and they're fully aware of it. They're a step ahead of you. And there is, allocating some resources where, IRS would go to the bank where you have your business bank account directly. Behind your back, they will get all the bank information, your ins and outs, cash in and cash flow out, all the information, and request financials from you as well, and compare the two together. You have no way to, hide from that. So it's very important that you maintain as clean of a book records as possible. Expand broker information reporting with respect to crypto. I know cryptocurrency have been so booming in last few years, and they are kind of looking at investing some resources so that reporting of the crypto can be can be normalized a little bit, and they can straighten it out. The average American spends more money in taxes in their lifetime than food, clothing, housing, and transportation combined all together. And many people still don't even realize. An average American would work 12 months a year, out of which 4 months of pay is going straight into taxes. Why don't we take 4 months of vacation instead? Something to think about. One of the biggest problems in this country is that the small business owners and individuals believe that their CPA, accountant, tax preparer is saving them money on taxes, but in reality, they are not. They are just preparing the returns, which is tax preparation. And we call it as a cost of compliance, putting in the right numbers in the right boxes in the right form and calling it a day. Whereas tax planning is the investment with the return on investment. It's the investment with ROI. Have you ever had tax planning done in the past? Let me see. I want to see it in the chat box. Put yes or no if you had any tax planning done in the past. Come on, if you're listening, I want to see if you had any tax planning done in the past. Yeah, I see no. What about others? Only one person? Not really. Yeah. Okay. Some, but question it. Yeah, if your accountant is just kind of giving you estimated tax payments, what to pay, that's not the tax planning, okay? That is just throwing you in the bus to pay the money. That's it. That's not called tax planning, just helping you make the estimated tax payment. If your accountant is helping you cut down your quarterly estimated tax payment bill, that is what is called tax planning. And also the important key point is remaining compliant. I don't see single yes here, everyone saying no, or maybe not really. So the truth is nobody wants to do tax planning. And why? Because it's so involved and it's very complicated. The US, the Tax Cuts and Job Act is 70,000 pages long, out of which only 30 pages tells you have to file the taxes by putting in the right numbers in the right boxes in the right form. Rest 69,970 pages tells you have to not pay the taxes, which is what we study and which is what sets us apart. I've not studied full 69,970 pages, and I don't have any intention of studying that many pages either. But the maximum which could benefit our client is what we are studying. And we learn something new every day. So what is actually tax planning? Tax planning is not something that can be done after the year end. You can do up to a certain extent, but not as much. You know, after the year end, what you can do is a tax preparation, which is the process of preparing tax returns for submission to the IRS. Whereas tax planning is something which is done before the year end, and it is a process of looking at a person's life, business, and regulatory requirements to legally reduce their taxes. And when we talk about tax planning to achieve tax independence, we talk about deductions, legal entity structure, retirement planning, insurance and asset protection, legal loopholes, Tax Cuts and Job Act updates, Family First Coronavirus Response Act, CARES Act, American Rescue Plan, American Family Plan, American Jobs Plan, all this COVID related bill updates, advanced strategies, industry specific strategies, exit and capital gains, and Biden proposed tax policy. These are all 11 areas where we focus to reduce the tax liability of our client. Think about it. If you have a bunch of employees, most business owners, they are kind of trying to save money on the employees' pay, or they are trying to save money on the operating expenses, rent, maybe some operating supplies, those kind of things, which are very small percentage of their total revenue. However, when you look at in comparison to your total revenue, all the expenses and your taxes is one of the biggest expense after paying your employee salary. It's one of the biggest expense for most business owners. And still, people happily cut that check with the heavy heart and donate that money to the IRS, which they don't really have to. It's just donating the money, which will never ever come back. And if you had this money available to yourself, you can have a better quality of life. You can probably donate even more and have more experiences for yourself, your kids, your family, and give better to better benefits to your employees. Maybe save for your retirement. We cut down all of those our good things that makes us feel happy just because we don't take enough steps to reduce your tax liability and happily with heavy heart donate your money to the IRS. Think about it. So here is one of our client. If we don't have the permission to share the picture of the client, this is our coolest way to share the testimonial. The case study, not the testimonial. So this particular client had a tax bill of $53,000. For 2020, they had engaged another accountant who prepared the draft tax return. And after that, she decided to, she was so scared of the tax bill, she didn't have this money going through the pandemic. And she reached out to us if we can help. And the best part about this, she had the draft tax return prepared by her accountant. But when we took, things in our hand, we reduced her tax bill to $13,000. That's almost about $40,000 of cash flow, which was generated by reducing her tax bill. She spent weeks without sleep and stressing out, where is she going to find that money? Where is that $53,000 going to come out to pay the IRS? So here's our situation: $890,000 in annual gross receipts, operating as an LLC, but no books to track expenses, managing numbers by ad hoc estimates. All expenses end in 3 zeros. Can you imagine that? And lots of co-mingling of personal and business expenses. So what we did is we reconciled and updated books, captured all missed business deductions and credit, optimized entity structure for liability protection and tax benefits, helped deduct vacations as business trips, and saved from lots of compliance issues while cutting down the tax bill. Can you imagine the amount of time we all spend thinking about telling ourselves in the back of our mind, how am I going to pay these taxes? Oh my gosh, I have to pay these taxes. My accountant doesn't know anything. I don't know anything. All of those negative self-talk and thinking about what to do, what not, asking Mr. Google ways to reduce taxes, checking on YouTube, reducing your taxes, whole bunch of these things. When you have access to the professional accountant who can reduce your tax liability like this, that's the difference. Do you want to spend more time doing it yourself, which you're not really expert about, or hiring a professional team member who can bring you time and more money? Hence, you can create more magic in your life. There are more than 23 million businesses in the US that are not properly structured. And this is not some based on ad hoc numbers, it's based on research, and even IRS agrees to this. And if this business are properly structured, they will have better audit protection, better compliance, and reduced tax liability, which is another big deal. If your entity is not set up correctly, you are overpaying taxes. An entity setup is something like, prescription medicines. Your body could be completely different than my body, and you can't take my prescription medicine, and I can't take your prescription medicine. And if we do, we could have a severe health consequences. And here, with the entity structure, the severe consequence is severe tax consequences. So that's kind of really important. When was the last time your tax guy came to you and said, here's an idea I think will save you money? Tell me in the chat box, when was the last time you can think about this, that your accountant came in, here's the idea which will save you money? I see never from GC Vigasya. Anyone else? Only one person. So all the other attendees, I think your accountant is giving you plethora of ideas. Kathy, I was also nice to see Kathy Lemmer. I first learned this with one of my clients, Jane, and she was 42 years old, and we were able to save her $18,000 on taxes in the first year and every single year going forward. $18,000 may sound to be smaller for the bigger business owners, but don't underestimate the power of this money, because I'm going to show you what this $18,000 can impact and how it can impact your life. She started investing $1,500 per month in her retirement account. Most of the time, people do like retirement. They do want to save their retirement account. The only reason they don't have money to invest in their own retirement, because they are donating money to the IRS, which they don't have to. If that cash flow can be freed up, anyone would like to secure their future. So think about it. Without increasing her income, without reducing her expenses, without growing her business, without reducing her lifestyle, and just doing tax planning, we were able to save her. What was that number? $15,000? I lost that number. So $18,000 in taxes. So we were able to save her about $18,000 in taxes without doing any one of those. And she was 33 years when we met, wanted to retire by the age of 67. She only had $1,000 money saved in retirement for one of the old job that she had, but nothing over and above. And she was planning to contribute that tax savings into the retirement account at only 7% return on investment. By the time she retires, she will have $3.3 million in retirement savings. This is the money, if it is not for tax planning, will be donated to the IRS. And if you are a little bit more aggressive, you can easily get 15-16% of ROI on your retirement account, not just 6-7%. This is very conservative return on investment, which is leading her to $3.3 million in retirement savings. And that's assuming no increase in income over that entire period. That's huge. The cash value of money that you have in your hand right now is even higher than what it will be 5 years from now, which we all know it. Earlier, when we went, before the pandemic, when we went to the department store or grocery stores, $100, and we can buy a whole lot of things. And now with the $100, our bags are half empty. So we all know the cash value, the present value of cash changes with the economy. So let's cover some questions, Q&A. I hope this all guidance have definitely helped you, and will open up your eyes that how taxes can impact your life, and why it is very important to be independent of taxes. You don't want to be dependent on tax payment, especially when it can be avoided. So, Darna, you want to go over any questions?
Yes, I see a question here. The corporate tax rate is 21%. However, you saying that 15% tax on total earnings. So in fact, we're talking about lower tax rate.
Oh, so I think we are mixing the two. Very good question and very good catch. 21% tax rate is for the C corporations. That's not changing. I mean, that will change from 21 to 28%. The 15% of net investment income tax or CICA tax is for the partnerships and S corps who are getting more than $400,000 in terms of distributions and profits combined. Does it help?
It does. And I would like to add here, you can think it in terms of sales tax. Sales tax is based on your sales, not the net income. So think about it like you feel like sales tax is too high, even at 6 to 10%. Here we are talking about 15% on top of that 5 or 10, whatever the state sales tax rate is. Next question is, so we know tax is increasing. What can we do now?
The next thing that you can do is we do offer complimentary tax assessment. And you don't have to take it, but if you want to see how good of a job your accountant is doing, you can schedule a meeting, send us a copy of your most recent filed tax return. Just because you have been you registered for this webinar, whether you attended it live or you're listening to the recording, I know so many people reached out for the recording as well. We will review your tax returns and give you a rough ballpark of how much extra you're paying in taxes. You don't have to work with us. It's no obligation at all. It's just one session that my team will do it. And most of these tax returns are reviewed by either me and Taruna. So we are investing our time just to help you out and get an idea of how much you're overpaying in taxes, which you don't really have to, which is completely optional. What else you got, Taruna?
Okay, then next question is, I'm planning to sell my property. Are you suggesting to sell it in 2021?
That's a very good question. I would say, what is more important to you? What is the outcome you're looking for? Don't be just scared about the taxes. You should be, but I would say if you're working with a professional like us, don't be scared about the taxes. We have had many clients who have sold the properties in last 12 months, and I have been able to help them eliminate their taxes. So here's the thing. Just last month, we helped another hotelier who was selling the hotel for $11.5 million. And they were expecting capital gain tax of $3.6 million. With our tax strategy, $3.6 million of taxes are completely eliminated. They will not pay now, they will not pay in future. So if you're planning to sell a property, come and talk to us and we will be able to help you. If you're just tired with the property and you don't want that hustle of going through with the pandemic, I know a lot of things have changed. Come and talk to us. Because you're worried about taxes, selling it now or selling it next year, I don't think that's the right question. What else you got, Taruna?
Okay. I think that's about it.
I see two questions here. I know you don't provide accounting services for the Trump organization, but how are some of these large firms only paying hundreds of dollars in taxes instead of millions? Can you share your thoughts on this? Very good question. And the whole reason why big firms are only paying hundreds of dollars in taxes is because they have the team like us and more, actually the whole crew, who is constantly working on their taxes and strategizing proactively. So if you're strategizing proactively, you can eliminate taxes with the right investment decisions as well as with the right tax strategies. It's a combination of both. In a nutshell, the combination could be what we call income shifting strategies, expense shifting strategies, and passive income, non-passive income, the whole combination of that. The next
I will
question,
add
go ahead.
I will also add timing on that. Recent example was like this big corporation, right? So when IRS announced credits for new employee hire, what corporations started doing is they started hiring more employees. They received that credits. Next year they fired all of them. Like they evaluated whole crew, and whoever not performing well, they got fired. But they received the benefit of this employee tax credit. So that's how they tax plan and receive these benefits and achieve that zero tax.
Yeah, absolutely. And the next
Okay,
question,
another question.
go ahead, Taruna.
Which retirement plan you just talked about, that $1,500 per month?
So the retirement plan that we had for this particular client, depending on her situation and where she wanted flexibility, was simple IRA. Again, the retirement plans are as well, it has to be unique to your situation and what's the outcome you're looking for. It's like, taking someone else's prescription, which doesn't work for you. The flexibility that she wanted and the end result she had in her mind at that point, it made more sense to invest in the simple IRA plan. As far as the return on investment is concerned, depending on how aggressive you are, allocating funds to the different buckets in your retirement portfolio, you can earn higher or you can earn lesser of the return on investment. So that totally depends. Perfect. We are right top of the hour and we covered pretty much, I think, all the questions here. Thank you very much, everyone, for joining us today. And we will announce the date of the next webinar when we send out, the recording of this webinar to you all. And if you have any questions and would like to avail the complimentary tax assessment, please feel free to share with us. And if you know any other business owner who can benefit from this, feel free to share this recording with them. All right. Thank you very much. Enjoy the rest of your day.
Thank you all.